This is the Cash Value Solutions Podcast, where your hosts, Jason Pohlmeyer and Kyle Manns, shed light on little-known money truths to help you take control of your financial future and become your own banker. Subscribe, rate, and review the show, and check us out at cashvaluesolutions.com.
Hey, everybody. Welcome back to the Cash Value Solutions Podcast. I'm here with Kyle today. What are we going to be talking about?
Well, we are going to be covering Dave Ramsey's newest video discussing whole life and infinite banking, where he calls infinite banking a scam, and we just feel like there's some points here that need to be cleared up because not everything is accurate.
Right. And it's easy for people to, listen to these people talk about finance on the radio, and, you hear a lot of things they say, it sounds good, and then they talk about something like whole life where maybe they aren't quite as knowledgeable, and they say some things that just aren't true. So we want to provide the details on why that is for you guys, or not why it is, but what he does get wrong.
Yeah, so we'll get started, and we'll just kind of play from the beginning here and go along with it.
Jason is with us in Detroit. Hi, Jason. Welcome to the Dave Ramsey Show.
Hey, Dave. Thanks for taking my call. How are you?
Better than I deserve. How can I help?
Well, I had a question for you. I've been working with a financial advisor who's given me some advice, and I follow the show. I'm on baby step 7 currently. But he presented me with an idea that was a little outside the box. And I have term life insurance. I've been anti-whole life. But he presented me with this infinite banking concept.
Jesus, you're kidding me.
Money. Yeah, I have excess money in a savings account and looking to rebalance my portfolio to get it to work a little bit harder.
Wow.
But my risk tolerance is a little bit low. And he showed me how you can do this where you overfund the whole life policy. Yeah. You can access the money. You break even in year 7, and then the dividend outruns what you put into it.
Yeah,
it doesn't seem like a terrible idea in that regard, but I just wanted your take on why that might not be the best.
So our first cut here, where we're going to discuss what we've just listened to, we want to first say that Dave Ramsey is talking to a certain group of people here. He's talking to the majority Americans who are in bad consumer debt, and he does a lot for people like this. Dave has a great strategy of getting people out of debt and then staying out of debt.
And he's great at motivating them to do this as well.
Yeah.
He's really good at doing that.
Yeah, so we're not saying that Dave Ramsey is dumb. He's obviously a very smart businessman worth hundreds, probably $100 million or better. So that's not the attack here. We just want to clear this video up for you guys, and to kind of start off with, Dave has no idea what the caller is going to be using this money for, what he would use this policy for. He just goes into starting saying, this is bad.
Right. I mean, the caller says he's on baby step 7, and, this is Dave Ramsey's program, so he has a little idea of where he's at financially. The caller says that he wants to rebalance his portfolio and stuff, and aside from that, we don't know whether this guy's a business owner, an employee. We have no idea how this policy would be used, and Dave doesn't ask that either. On a side note, whole life insurance can be an excellent asset as part of a portfolio, though, as a great alternative to bonds and portfolios. So it could do a tremendous job of helping this guy rebalance his portfolio.
Well,
way to go.
The problem is that where it gets confusing is that, he's selling a dividend. A financial advisor? This is an insurance guy.
Well, he's both. They have, it's one of the bigger companies.
Like Northwestern Mutual or Prudential.
Exactly.
Yeah. Okay. He's an insurance guy. He's not a financial advisor.
Okay, I was about to say.
So, because those are both mutual companies. Now, there are two types of life insurance companies, mutual and stock. Okay? Likely you bought your term unless you bought it from him, from a stock company. A stock company, stockholders own the insurance company. A mutual company, which is Pru and Northwestern, State Farm is mutual, is the policy holders are actually the stockholders. Okay?
Okay. Yep.
So when the company makes a profit, the policyholders receive a dividend as if they were a stockholder and received a dividend. Does that make sense?
Yep.
Now, follow the math here. If you are the owner of the company and you're also the customer of the company, and the only place the company gets money is from the customers that are owners, and they give you money from a profit, by definition, that means it's because they took too much from you as a customer. There wouldn't have been a profit otherwise.
Okay.
So the IRS has deemed, consequently, that mutual life insurance company dividends are not dividends in the true sense of a dividend, that instead they are, and this is the IRS's language, they are instead a refund of a deliberate overcharge. So they overcharge you in order to give you some money later to make you feel like you're making money off of them. And it's absolute hogwash. It's a pass-through.
Okay, I think we should stop the video here, Kyle. Dave goes on in the beginning talking about mutual companies, Prudential and Northwestern. And I only bring this up because Dave goes on about this later in the video. But Prudential is a stock company. They have been since 2001. So I want to be clear about that. Dave further goes on to say then that dividends are a deliberate overcharge. Now, I think that he's doing an okay job of describing dividends, but he is using a little bit of misleading terminology here to make you think that it's this terrible thing, when actually a dividend is a great thing. You want to have the company share the profits with you, which dividends are profits, excess profits that the company has generated. And if they aren't generating dividends, that's a bad thing for you, because then your policy is growing by a lesser amount. Dividends are a really good thing.
He also makes it sound like that the insurance company only makes money from you, and that's just not the case. Yes, they take your money as premium and they invest it.
Absolutely.
But they're investing in real assets such as real estate, business, bonds,
policy loans.
Yes, things along those lines.
Yeah, the insurance company, it isn't just like they're taking $100 from you. It only took $70 to deliver on that promise, so they're giving you the $30 back. It's much more complicated than that. They're investing that money. We should also say, just for a simple example for you guys to understand, and this will draw the lines together so you can really see that isn't how it works. Imagine that you buy a policy at, say, 25 years old, and you have to pay premiums on it. Now, this is a whole life insurance policy, but you have to pay premiums on it until you're age 65. And let's say it had $1 million death benefit, and over that time, between age 25 and age 65, you paid $300,000 in premium. But the company is on the hook for a $1 million death benefit. If the only place they made money from was you, where would that $700,000 come from? They wouldn't be in business, would they, Kyle?
Exactly.
So that's just one area where that's misleading information or not information, but misleading terminology that's trying to make this sound like it's something that it isn't.
Mathematically, it's a pass-through. It's the way it has to be. It's the legal definition of the freaking company, and the IRS says so. So,
yeah. The thing I didn't love is, when you take the money back, you basically are paying an interest rate on it. But
exactly. And whose money is this?
Right.
That you're borrowing your own money and you're paying them interest?
Yep.
This is infinite banking for them.
The caller says that something he didn't really like about this idea was that to take your money back, you got to pay an interest rate on it. And Dave agrees and says, yeah, you're paying an interest rate on your own money. That's infinite banking for the life insurance company. But the truth is, we're using the life insurance company's money. We're using OPM, other people's money here.
Yep, it's not your money. You aren't paying interest on your money.
No, and we use policy loans so that our money sits there and grows at uninterrupted compound interest. That's the beauty of the system.
Absolutely. And you can take that idea, and then you start to see what opportunity cost is, okay? Because if you withdrew your money, it wouldn't be earning uninterrupted compound interest. So there is an opportunity cost to, if you use your money or if you use the insurance company's money. One way you're paying interest, the other way you're not earning interest.
Yeah.
Yeah, the infinite banking concept is old school, whole life, done poorly. You need a real financial advisor, not an insurance broker that's trying to sell you a load of manure. And so, yeah, the other thing is that your cash values that are sitting there all die with you. So whatever cash you put into this is equals zero at your death because they only pay the face value. Pru does not have a policy. Northwestern Mutual does not have a policy that pays more than the face value except Universal Life Bs, which are not in infinite banking products. And Universal Product B is where they charge more than they usually charge, which basically buys the insurance so they can still keep your money, is the way the math actually works on this. So you're dealing with one of the most expensive insurance products in the marketplace. If you're dealing with either one of those two companies, I would stay completely away from both of them. They're everyone in the financial field except people that work for them, we all think they're a joke. All of us. Anyone who's academically trained or has any kind of CFP or anything else, when someone says they work for Northwestern Mutual, we just kind of laugh and go, yeah, right, you screw people every day.
Okay, I think we got a lot to break down there, Kyle. First off, Dave says the infinite banking concept is old school whole life done poorly. We use whole life contracts, and these things have been around for a long time. They're updated by insurance companies when new CSOs come out, but it's the structure of these policies and how you design them that really makes them work for infinite banking. We just did a podcast about that, describing the base, the PUAs, the term riders, and things like that. So while you can buy whole life that, wouldn't accumulate cash very quickly, which is what, old school whole life would be, that isn't to say it's bad at all either. It's just, it's a different design. It's how the policies function.
Yeah, I mean, the contract, yes, it's old school, but the way we're structuring it is not. So it's really not old school. It's not the old school thought of whole life.
Right. And, then he goes on further to say that your cash values that are sitting there all die with you because they only pay the face value. That's true. They do only pay the face value. They do not pay you the cash surrender value. You know what, Kyle? The death benefit is always bigger than the cash value, and I'd much rather have that paid to my beneficiaries at death. Furthermore than that, the cash value is just a representation of what the death benefit is at this point in time.
Yeah, it's like equity in your house, like we've said many times. It's the net present value of that death benefit.
Right, minus the future premium payments. It's just a reflection of the death benefit at this point in time. And, if you had a 401k, Kyle, let's say, and you're 27 years old, is that right? Or are you 28?
27.
27, okay. And so you have a good share of life insurance on you, and the cash value is far, far less than the death benefit, right?
Yep.
So if you had a 401k that you housed that money in and you died today, your beneficiaries would get that dollar amount.
Yep.
But with your life insurance, they actually get far more than what the cash value is.
Yeah, a lot more.
Is that okay with you?
Absolutely. 20, 30 times more.
Yeah, he's sort of, I'm not sure what the right word here is, but I don't know. I truly don't know if he doesn't understand how that functions exactly, but it's not a good portrayal of the truth, I guess. It's very misleading again, as a lot of his comments are regarding this whole life.
Yeah, and he also goes on to say, kind of bashing the Northwestern Mutual people that, you guys are just screwing people every day, which I think you gotta have a little proof there if you're gonna make comments like that.
Yeah, I mean, who's laughing at the Northwestern Mutual guys aside from Dave Ramsey? I mean, give us some proof, You have the numbers here, Kyle, of there's a lot of banks that purchase bank-owned life insurance, and big time sums of it as well. Yeah,
so of 2017, JP Morgan Chase had $10.9 billion in permanent life insurance. Wells Fargo had $18.3 billion, and U.S. Bank had $5.7 billion. So,
and where do banks get bank-owned life insurance from, Kyle?
well, they get that from their profits.
Well, I mean, they get it from life insurance companies, though, right?
Oh, yes.
Isn't that what Northwestern Mutual is?
Yes. Well, I don't know that they use Northwestern.
Yeah,
we
I'm
don't-
not saying that, I guess. I'm just saying that they get bank-owned life insurance from life insurance companies.
Mm-hmm.
I don't think the banks are laughing at the life insurance companies and they're buying their products at the same time.
Yeah.
We should note in there, though, Dave does get right that we do not use universal life products when we set up infinite banking policies.
Yep.
So he's correct on that.
Yeah, so, dude, you need to get away from them and you need to go get a real financial advisor that can help you do some real investing that takes into consideration your low risk tolerance. Low risk tolerance does not need to lead you to losing your money 100% of the cash invested at death.
Yeah.
That's a bad risk tolerance thing. So you need to move on, dude. You need to move on. But because the whole thing of the dividends are paying for it is such a joke because the dividends are the refund of a deliberate overcharge. So who's paying for it? If you were getting dividends if you own Home Depot stock and you got dividends from that, then Home Depot's making a profit, but they're making a profit off of their customers.
Yes.
And I'm the owner of the investment. I get that dividend. That's different than if I am the customer and I'm the stockholder, thereby the only way I made a profit was off of me.
Myself.
So I pay you an extra $100 and then you give me 70 of it and I'm supposed to feel great about that.
Right. Yeah.
So that's what this amounts to. And so you guys that working with State Farm, when you get your little dividend check, that's what it is. It's the refund of a deliberate overcharge. IRS verbatim says that.
Yeah.
And that's why you don't get taxed on it. If you get a dividend on Home Depot stock, you get taxed on it as income because it's real income. You really made an investment, and then you really made an income. So that's...
Okay, Kyle, I got just a short thing I want to add here. I agree with Dave. He's doing an okay job here again of explaining dividends and how there's a difference with stock companies that you might own and mutual life insurance companies and dividends that you get from them. What I think is misleading here again is the fact where he's saying that it's just a return of premium, and that's why there is no taxation on the dividends that you receive from life insurance or mutual life insurance policies. Well, why is it then that you can draw out so many dividends that they become taxable on a life insurance policy? Because it's not just an overcharge of premium. There's also investment income that's going into that. You know, insurance companies, these are guaranteed contracts, so they're charging for the absolute worst case scenario. And when they do better than that, they share the profits back with you. Dividends are an excellent thing, and if the companies weren't paying dividends, that would be a bad sign for the industry. Dividends are a very good thing. Kyle, would you want a company that you are an owner of to be profitable?
I'd want them to be as profitable as possible.
Well, dividends are a very good sign of that.
Absolutely.
They're returning you profits from the company.
That's what's going on with that stuff. And so do not buy anything in the life insurance world based on dividends. You look at the price, look at the structure of the policy, and you'll usually find that mutual companies, by the way, are the higher priced.
Yeah.
So when you go to a quote service, like a Zander Insurance, and you get quoted on term life insurance, you're going to find no mutual companies in the 42 different companies that they give you a quote from because they're not competitive.
That's it.
Why? Because they charge more so they can give some of it to you back later and make you feel like that you got something.
Okay, here Dave says, don't buy based on dividends. Look at the price, look at the structure of the policy, and you'll usually find that mutual companies aren't competitive, right? They're higher priced, okay? So he mentioned Zander's Insurance in here, and I put it to the test, Kyle. I went on there, and I looked if there's any mutual companies on his quote service. How I did that was I ran myself through their system and looked up what it cost to buy $1 million of death benefit for a 20-year level term policy. What I found was there actually are mutual companies on there. There's Savings Bank Mutual Life Insurance Company. There's Mutual of Omaha. And by the way, they were not at the bottom of the list. And I was also curious because a mutual company that I work for wasn't on there. So I ran myself with Penn Mutual, and they came in at $384 annually, which is seventh best from the best price that was quoted on Xander's Insurance of $363.60. I don't quite see how this is the whole truth.
And
that
then
Dave
also
is telling us.
He's not taking into account of with mutual companies, it can also be easier to then convert that term into a whole life. So
Sure.
you might have some more options.
Sure, if you buy a convertible term, for sure. And I also think that it's worth mentioning that not all companies want to sell all products just because they have that product. And they don't come out and tell you that, but you can tell because they won't be price competitive on a product.
Sure.
Okay. Not every company wants to be in the high cash value life insurance business. Some companies just want to sell death benefit to you, traditional whole life. There's nothing wrong with that. It's just that companies have different focuses.
Yep.
That's really what it amounts to. And that's why you won't find them. They're not competitive.
Yeah. Dave, you're fired up about this one.
Man, I tell you what, pisses me off. Infinite banking my butt.
Okay, Dave.
Infinite banking is for them.
Yes.
The only thing that agent has for his whole life is a need for your commission to be paid to him.
Absolutely.
That's the only whole life thing that is involved here. These products are horrendous.
Yeah.
And it's bad enough when they feed on the middle class, but that guy's a baby step 7, man. He's probably a millionaire.
Yeah.
And they create such a jumbled word picture that you can't cut through the BS. And yet, the thing about him, did you notice what happened with him? This is interesting. It didn't feel right to Jason.
Yeah.
He felt it, didn't he?
Yeah, he felt it. And that's probably because he's going through our process and he knows what we teach.
Well, it's not just that. He didn't just say, well, Dave says it's wrong.
Right.
There's something wrong here. I just can't put my finger on it.
Yeah. Overpay and get money back.
But I mean, you ever have those feelings? I don't know exactly what's wrong, but I smell a rat.
Yeah.
Which means there's a dead rat in the corner somewhere.
Yes.
I just hadn't found him yet.
Or below the couch.
Something stinks in here.
Yep.
Something stinks in here. Something got in the house and died. I got a smell in here. What is it? Something's wrong. You can't find it.
Yeah.
You can't put your finger on it. But how many times have you been in a situation with a person or with a product, a financial product? You had one. You were buying an item. I won't say what it was on the air, but you got the smell off the people and you ran. It wasn't 3 weeks ago.
What was it, Dave? Tell me. You got to have What was it?
I'm not going to because they might be listeners and I'm not going to do that to you. I'm going to throw you under the bus.
No,
but
say
you
it.
walked out of a deal into a different deal not long ago.
Oh, yes, sir. I
And
did.
was it not the same thing?
It was the exact
the Holy
same
Spirit inside of you said, I smell a rat.
Yes, something's not right.
Something be wrong
And
with these people.
I ran.
This deal is there. I can't put my finger on it,
Yep.
but this deal is bad.
Yes.
And you ended up in another deal that's a much better deal because you listened. Even though you couldn't logically explain it, you could listen to your heart.
Absolutely. Yep.
Listen to the bell when the bell rings. Whew. It's called the Holy Spirit.
Yeah, thanks.
This is the Dave Ramsey Show.
Okay, so a couple things here. First, he says all these insurance agents want is your commission. And if you look at how we structure policies, we cut our commissions by 75% of what traditional whole life would be.
Yeah, in most cases, 75% or even more sometimes.
Sure. And when you compare that to management fees and 401ks, even those 1% fees, those things get huge. I mean, that's going to be way more commission than an upfront insurance commission fee.
Absolutely. And we're only getting paid when you pay premium. If you aren't adding money to a mutual fund or a 401k or something like that, there's still a management fees that you are charged. Even if you're not adding to it, they're still getting paid.
Yeah, so that's a little misleading there. And then kind of the second thing is Dave opened up this with the guy saying, oh yeah, I've heard of infinite banking. And he says, Jesus, cursing in Jesus' name. And then here at the end, he's like, oh, you felt the Holy Spirit in you, that you smell a rat. It's like, okay, what are we doing here? We're saying that we're this, huge Christian, but we start off with cursing Jesus. So I feel like that's not very consistent. And Dave is, he's well known in churches, and that's one of his big target market is churches. That's where a lot of people first hear of Dave Ramsey.
Yeah, and so this podcast isn't meant to be calling out Dave Ramsey. This is just meant to shed some light on what is truth behind what's being said on the radio, where who knows how many thousands of people are listening, and what is false. Okay, this isn't meant to be anything more than that. Hopefully this provided value to you guys, and this is going to help your decision making in the future. So that's all we've got today.
Thanks, guys, for tuning in this week, and we'll be back next week.
This was the Cash Value Solutions Podcast. Remember to subscribe, rate, and review the show. Check us out at cashvaluesolutions.com. And don't forget to tune in next week.